Welcome back to Portfolio Builder. This is going to be episode 5 on investing strategies, and this is one that's going to be pretty simple. Before we get started though, just want to go through the standard disclaimer: not a CFP, not a CPA, and certainly not a financial expert. When you're looking at what investing strategies to use once you've set up your brokerage account, you need to ask yourself a couple of questions. What is your timeline? Are you going to be active or passive? And then whether or not you want to use short-term or long-term investment strategies. So first, the timeline. What's really important to know is when you're planning on drawing on that money. If retirement is going to be 30, 40 years from now, your strategies are going to be a little bit more different. And what I mean by that is you have a long time horizon. If you're to just dollar cost average into stocks or index funds, you'd have a lot of time to try to make that growth so that you can build your money into something really meaningful. But if retirement is 5 or 10 years around the road, your timeline is getting shorter and shorter, and the more risk you take in just more stock allocations, the more kind of risk you're going to expose to yourself to, say, if during the time of retirement, the stock market were down. If you were dollar cost averaging, let's say into index funds like the S&P 500, and the US economy was in a bad time, those top 500 companies were doing poorly at that time segment where you need to retire. Well, basically, the US economy is bad, and then it's a double whammy because your long-term investments are now suddenly trying to be drawn down at a poor time. And so paying attention to your timeline is important because that'll shape how much go to, let's say, stocks and index funds versus more stable things like bonds. And so that's one thing to kind of figure out is what is your timeline, and that should shape kind of what your investing strategies are going to end up being. The second is going to be, are you a passive investor or are you an active investor? A passive investor might be someone that just dollar cost averages into index fund, whereas an active investor might be wanting to swing trade. They might want to get into options and other things. And so you need to just pick and choose what strategies you want to use. It doesn't mean you have to be mutually exclusive. So you could say 10% I want to be active, 90% I want to be passive. That's the strategy I take. The 10% of being active, generally, I might be able to outperform the market for 3 months. But if I go over 1 year or 5 years, my ability to outperform the market is not very good. In fact, I probably underperform the market. And that's why that 10% there is just more to keep me engaged, to keep me wanting to stay on top of things. But by and large, I'm not expecting that 10% to secure my retirement. Having that 10% set aside is trying to keep me from that other 90% from trying to actively manage it. And that way it keeps that money safe from me. And then the third thing is just going to be, if you're going to do long-term investments, you need to just come up with a strategy and just try to stick to it. Having a plan written out is going to be important when you have red days like the start of 2022, when things are volatile, and it's likely going to be that way for the first quarter of 2022. That being said, so we're going to talk about kind of different strategies, first being short-term. So the short-term ones are going to be things like day trading. I don't advise that to you. I think that's a very good way to lose money. I'm not really familiar with the rules, so I'm not going to touch on that one much. The second would be swing trading. Swing trading allows you to come up with a couple of stocks or ETFs or companies that you want to invest in for a short term because you think there's going to be some positive momentum, either from a catalyst like an earnings report or some news, or potentially, like if you're in biotech, potential FDA approval. These are things where you'd bet on a company expecting a short-term price movement up, and then just you set your predefined kind of exit and entry points and you just stick to it. So you might enter in, it ends up being right, you exit out. You don't try to chase higher up gains because you might set yourself for the market turning on it and then losing. You also set an exit point, even if it's a stop loss, so that you minimize your exposure to losing money. And so that's kind of swing trading. Swing trading is a way that some people try to make an active living, but that means that you have to be dialed into what the stock market is doing in the specific companies. That requires time invested, learning about technical analysis, fundamental analysis. And if you're not prepared to do those things, then swing trading might not be the best thing for you. It might be fun to do, but I wouldn't do that with the bulk of your money that you're going to then depend on in retirement later on. For the third one, it's going to be options. Options, not something I'm really familiar with. I'm trying to learn a bit more about it. But that's something that there are plenty of other YouTube channels you can look to. But it's a way of leveraging your money where you can buy the options to exercise, and then you can either flip it or you can exercise and buy those 100 shares per kind of that option. But for me, what I like to talk most about is going to be long-term investing. Long-term investing is something that's important. You can do buy and hold, you can do dollar cost averaging, you can do retracement addition, which is something I like to do, where I might dollar cost average a set amount, but when I see a pullback, hopefully not a reversal, I add more money to it. So let's say I was investing in the S&P 500 every 2 weeks. If the S&P 500 during, let's say, a month pulled back like minus 1% or minus 2%, something really bad, if I have extra money that's in a cash reserve, I would just dump it in at that time, in addition to my usual set dollar cost averaging schedule of, let's say, every 2 weeks. But that's my personal preference. One thing you need to be aware of is dollar cost averaging is something that can be good for things like index funds, but the minute you start to apply it to stocks, you need to just be really careful to understand what that company you're dollar cost averaging into. If it's a healthy company, then sure, it's going to be fine in the long term. But if you're dollar cost averaging into a shaky company that the fundamentals have changed, it's become negative, you could just be putting more money into a sinking ship. And that might be a whole lot of averaging down, rather than the whole idea with dollar cost averaging is that it might be going up and down, but the hope is that it's going to have an upward trend, and you're not going to be buying too much at high value and too much at low value, but the overall kind of weighting is going to favor towards the lower average share price. Because let's say you had $100 and you're doing it every week. If you were trying to buy $100 worth of shares and the share price went down, that $100 would buy more number of shares. Whereas let's say a couple of weeks later, their share price was higher. That same $100 wouldn't buy as many shares. So when it's lower, you get more shares versus when it's higher, smaller shares. And when you average it out, the average share price will be weighted more towards the lower share price. And that's why dollar cost averaging is thought to be a great strategy for new investors. But that's generally if you pair it with the right index fund or stock. And that's why if you did it in a risky stock, that could lead to you just hemorrhaging money, because if it's just going down, it doesn't matter that you keep putting money into it. You might be lowering your average share price, but if that's not going to eventually rebound and come back up, you got problems. And so those are just some investing strategies. Hope you found this helpful, but don't forget to like, subscribe, hit the bell so you know when new videos come out. Thanks for listening.